Well, we are going to do our best in the next 5 minutes to try and give explanation for the market craziness that we have been experiencing and some of the things that should be and aren't. So let's take a look at where interest rates are today. They are significantly higher, y'all. And we're going to talk more about why here in a minute if we can wrap our brains around it. Mortgage News Daily has a 30-year fixed rate conforming loan, national average 6.92%. Y'all, a week ago, we were at 6.63% in that same survey. We were at 6.72% 30 days ago. So we're up about a quarter of a point in the last month. We're up a third of a point from where we were a week ago. And that's not insignificant, y'all. For folks in the mortgage industry, those are big moves. We had seen such a nice reprieve in interest rates going into early last week that we thought that we were starting a great trend line. We were down into the mid sixes. It was pretty easy to get into the fives. In fact, I was quoting fives on government loans last week. And then this market hits, all of the news around tariffs and the turmoil that we have seen in both equities and in the fixed income market around what trade policy is going to be. Y'all, the market has grappled with trying to define where this is headed and what the direction is going to be with regard to trade. Are we looking at tariffs? Here's where the market is trying to figure out where the administration is. Are we looking at tariffs as an opportunity to get all tariffs done away with? In other words, we're going to threaten them, impose them, negotiate tariffs away with all of our trading partners, and we're all going to get to zero tariffs. Is that the goal so that we get to actual free trade? Because that would have the great effect of lowering prices for everyone. That's a much different calculus for the market, y'all. If we're trying to get to free trade, as some folks in the administration are saying, like Musk, then that's going to be well received by the market, especially if these tariffs achieve that goal and if they go away quickly. If the opposite is true, that we're going to manipulate the market with permanent tariffs in order to change the production base at home, well, that's a different calculus altogether. And if the market is grappling with that, then we may see a more protracted, extended road. Y'all, I am a free market capitalist. There is nothing free market or capitalistic about manipulating production with government edict. It is pretty much the opposite of that. So it is a dangerous thing to play with regard to free markets. My strong bias, y'all, is that we need to be using these tariffs to combat the unfair trade that other nations have imposed on us to get to a zero tariff model. If that's where we're heading, I can rationalize that with my free market ideology. And I think that's going to have the best result for the markets because we have had folks internationally that have not treated us fairly. So I'm not opposed to tariffs as far as a bludgeoning tool to force equal trade. When they are standing toe to toe with us on the cost of production and on the cost of exports and imports into our respective countries, I'm all in favor of that. We can compete on that stage. If that's where we're headed with these tariffs, it's going to be a good thing if that's the result. And it looks like, with the exclusion of China, that's where we're headed, y'all. We have, according to the Commerce Department, 70 countries now have scheduled negotiations with the Trump administration to moderate their tariffs on their end and to establish free trade with our country. So we are seeing China well isolated now with the pullback for the rest of the world. They're standing alone in opposition to us now. So it's going to be interesting to see where it all hangs out. You now have my biases, but that doesn't explain the big elephant in the room from an interest rate standpoint, y'all. Why are rates up when the Dow has had such absolute turmoil over the last week? Normally, that kind of turmoil in equities pushes folks into the relative safety of the fixed income markets as a safe haven for their money. Right? They earn some yield and they don't have to worry about these massive drops that we see day to day on the Dow. They escape volatility by going into fixed income securities, and we're not seeing that. So the question is why? Well, if you get online, folks, you can't find a couple of economists that agree on this. There is all kinds of rampant speculation from China spitefully selling their U.S. Treasury position. And in so doing, they're polluting the marketplace, driving prices down and yields higher. Well, that might make sense if you look at it from just a retaliatory standpoint, but China would be hugely disadvantaging themselves if they were to do that. The whole reason that China holds US treasuries is to strengthen the dollar because that helps them from a trade positioning standpoint. It allows folks that buy Chinese goods, a largely export country, uh, to buy it more cheaply and to buy more of it. So it literally upends their entire trade policy and their entire monetary policy to sell bonds that, frankly, are more profitable for them to hold than they are to sell into the current environment. So additionally, when you look at the dollar versus the dollar is strengthening against the yuan right now. That is not what would be happening if they were selling their securities. So China's not selling their treasuries, y'all. So what's happening is, I think, twofold. And I'm going to try and make this as quick and as non-technical because, frankly, I'm not an economist. I just read. There is something called a basis trade in the treasury markets that is driving a huge amount of volatility in the fixed income markets. Essentially, you have folks that are taking advantage of volatility in the fixed income markets to both buy and sell treasuries and then to buy and sell futures against those same treasuries. And there's a little bit of a spread that they're able to keep. It's like guaranteed money. It's a very small amount relative to the size of the overall trade, but frankly, they're using borrowed money to make these trades, and they're using massive dollar amounts of leverage in order to do it. So for them, even that minuscule percentage winds up being very significant to their bottom line, and it's a safe place for them to make money. That is moving treasury yields in the wrong direction, and it's just based on this basis trade in part. The other part of it is just simple. People are scared of volatility and they're pulling their money out of both markets, equities and fixed incomes, and holding it in cash. I think that explains those two things together, the basis trade and folks just parking their money in cash until they see where this is headed. I think those are the two things that are pushing treasury yields higher, pushing prices lower. And when that turns around, it's anybody's guess, y'all. The market completely shrugged off the lowest read on inflation in over a year. We got the consumer price index today. We had actual core prices reduced by 0.1%, y'all. 0.1%. We were expecting them to be up 0.1. So we had a 2%, a 0.2% swing in the month over month CPI. Not expected, y'all. That's a much softer read on inflation. We're now at 2.4% on the core inflation rate. 2.6% is what was expected. Ordinarily, you would see bonds rally massively on that news. They did the exact opposite again, because folks are just simply pulling their money out of the market, or we have a lot of manipulation in the treasury market right now, or in the fixed income market, due to basis trading. I know that's a lot of complicated information, y'all. I'm going to keep an eye on it. Hopefully, we will see bonds a little bit oversold from where they are right now. I'm starting to see a little more green on the screen than red as far as bond prices are concerned. Hopefully, we will have better news to report soon on that. But we were nudging 7% day before yesterday in the bond market, y'all. We're off that a little bit. But we're going to be high sixes for the foreseeable future unless something dramatic happens. And as always, I'm going to keep you posted on what that might be. In any event, y'all, you can tell that we do a lot of work here at brycehomeloans.com to study the market and give your borrowers the best opportunity to lock in before these wild swings hurt them, or to float their rate in order to take advantage of what these swings might give them. I watch it carefully, y'all. That ability to time the lock in for a borrower is infinitely more valuable than shopping 20 different mortgage companies over a 3-day period. Y'all, we're all selling and buying money from the same sources. So in any event, I encourage you to let me put that expertise to work for your clients. Stay blessed, stay safe. We will talk to you next week.